I'm sorry. Can you see my screen?
Yes.
Okay, perfect. And you see the intro slides?
I just see your home screen.
Interesting. All right. Quick technical difficulties on my end. I apologize. I see people are starting to join. Welcome in. Thank you for joining us today. We have another minute or so before we kick things off. And once we're there, we'll start the presentation. I want to give people some more time to join though. There we go. All right, I see people are still joining in. Welcome in the people that are joining. Just another minute. I'll give some people another minute. I know it's 12 now, but I understand people are still connecting. So one more minute and I'll kick things off. All right, that should be enough time. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Litigation Finance, the lucrative, recession-proof, and rapidly growing asset class you need to learn more about with Experity Ventures. As a quick note, please be aware that Experity Ventures will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me, and I would be more than happy to help. Without further ado, I'll pass the controls over to you.
Excellent. Welcome, everyone. I am Andrew Zook with Experity Ventures. I'm responsible for investor relations at our elite group of companies that specializes in providing non-recourse pre-settlement cash advances to plaintiffs with pending personal injury lawsuits. The litigation finance asset class is a lucrative, recession-proof, fast-growing one. Today, the Experity Ventures executive management team is going to shed light into our unique business, give you some insight on financials, our underwriting algorithm and criteria, and our impressive company growth. Before I turn the presentation over to our CEO, Ryan Silverman, I want to highlight several achievements that illustrate how well our team of 50 execute the company vision each and every day. First, that Experity executive team that you're going to hear from today has over 55 years experience in our unique industry. Their leadership is responsible for the growth of company assets from $10 million 5 years ago to over $400 million today. The Experity business model. On average, Experity advances $1 and receives back $1.49 in 18 months or less. We have historical default rates of less than 2.3% of advanced capital. So Experity enjoys very impressive margins in a business that is virtually recession-proof. Our company's been recognized on the Inc. 5000 list of fastest growing private companies in America for 3 successive years. We've achieved very high rankings on that list in 2021, 2022, and 2023. Now, in case some of you have to jump off the recording early, I'm going to share my screen. All right. So at the end of today's presentation, Kama is going to share the presentation with you. In our slide deck, this slide is slide 1 and 11. For those of you who like what you hear today and you have interest in our high yield, income focused private credit investments, you'll be able to contact me in several ways. You can scan this QR code at the bottom of the screen here. That will connect you directly to my calendar. You can book a 15-minute phone consultation with me where I can shed information on our company, our investment opportunities. I'll answer all your questions, and I can review the private placement memorandum with you also. The phone number on your screen is my cell phone. Feel free to call or text it. It'll reach me directly, and my email address is also listed on the screen here. Now I am going to turn it over to our CEO, Ryan Silverman, who will fill you in with a lot more information.
Thank you, Andy.
You got it.
Good morning or good afternoon. My name is Ryan Silverman. I'm the CEO of Experity Ventures and all of its related subsidiaries. Experity Ventures LLC is a leading technology-driven alternative asset platform focused on litigation, finance, providing both pre-settlements, medical funding solutions, and attorney funding solutions to claimants and medical providers across the U.S. With me on this call today is Mike Shaw, our CFO, Ken Bonenberger, our General Counsel and Chief Risk Officer, and Maria Davidson, Director of Business and Operations. Like Andy said, litigation has become an integral part of a multi-billion-dollar business, and it's growing 20% annually, with estimated annual growth of approximately 25%, $160 million plus total settlements in personal injury. I'm going to turn this call over right now to Ken Bonenberger, our General Counsel and Chief Risk Officer. Ken?
I was on mute. Apologies. Thanks, Ryan, and good afternoon, folks. Now we're going to take you through some of the details of how a personal injury case proceeds and how a case goes forward when the plaintiff is receiving funding for their living costs, and then also some of the medical providers are receiving funding for the treatment that they're providing to the plaintiff. So looking at this slide, going from left to right, the first step of any personal injury case is there has to be an accident of some kind, whether it's an MVA, a slip and fall, medical malpractice, whatever it may be. That injury occurs, and then typically what happens, they either go, the paramedics come take them to the hospital, they go to the ER themselves, they follow up with their primary care physician either that day or within a reasonable amount of time, or an urgent care center. And then that's when they're initially diagnosed with whatever injuries they may have. Usually, you're dealing with a cervical spine, lumbar spine, maybe a shoulder or a knee tear, or herniations of discs in the back, things of that nature. And they begin a course of treatment that's usually in that 1 to 3 month circle that you see there. Usually it initially starts as some kind of conservative treatment, whether it's going to a chiropractor or getting physical therapy. They're trying to get an assessment of, the extent of the injuries and the best way to treat them. Then within that 4 to 8 month period, there's usually some diagnostic tests that are run, whether it's MRIs, EMGs, pain management, such as, epidural steroid injections. things of that nature to treat the initial injuries in a conservative fashion. And again, they're still trying to understand the extent of the injuries. But at that point in time, the medical providers are treating the plaintiffs, and frequently these plaintiffs don't have insurance or they're underinsured, and they need treatment. However, so what they'll generally do, they and their attorney will provide what's known as a letter of protection to the attorney, I mean, to the medical provider, saying, "Hey, doc, we can't afford to pay you now because we don't have coverage, but they have an ongoing lawsuit, and if and when that case settles, we're going to take care of you and pay you what you're, satisfy your bills." But those doctors, unlike us, they're not in the financial business. They're there to provide treatment to these injured plaintiffs, and they want to be paid, in and around the time that the services are provided. So what companies like ours will do, will come in, we'll take a look and underwrite the treatment, their bills, the extent of the injuries, and if it meets our underwriting standards, we can provide funding to them and acquire those letters of protection that were provided. So we effectively stand in the place of the healthcare providers. They get their money now, and then we hold on to the LOPs or the paper. And when that case settles, that's when we get paid instead of the money going to the doctors. Um, so again, at that point, and according to this model, there was an LOP that was issued for whether it was MRIs or pain management, and we paid the medical providers $2,500 at that point. Similarly, the plaintiff is in a position where they're unemployed or underemployed, they're out of work because of their injuries, they just don't have income coming in because of the injuries. That's where we fund them in that diagram there, $1,500 in advance, which which will help them with their rents. It'll help them with their monthly bills. Things that just their daily living expenses is what we're providing the funding for. Now, as the case advances, usually as the case advances, the conservative treatment may or may not be effective, and if it's not, we're in that circle there, months 9 to 16. Now they start getting more serious treatments. They're getting surgeries, whether it's an arthroscopy of a shoulder or a knee, for instance, or they're getting a discectomy or a fusion of their neck or their back, stuff that's going to remedy the situation. And in those situations, again, the medical providers similarly uh, uh, want to get paid, so we'll step in and we'll their buy their LOPs for $7,500. Now, similarly, given the fact that they're getting more invasive treatments, more expensive treatment, the value of their personal injury case is rising as a result of that treatment. And again, given that they're getting this invasive treatment, they're still not going to be able to work. They're going to be laid up for a period of time while they're recuperating from the surgeries, and they need more funding. And so that's where you see the pre-settlement funding box there, where the plaintiff is getting $7,000 more funding to get them through the out of work period. Um, again, 17 months to 24 months is the next stage in the life cycle. At this point, the attorney is put the case into suit. They're going through discovery against the defendant and the defendant's insurance carrier. They're working up the case. And again, while they're doing that, to help them get through that period of time, we could then give the plaintiff, based upon the value of the case and its increasing value, we can give them another $1,500 advance. And then we get to the 24 to 30 month period. And generally speaking, the life cycle of a personal injury case is 18 months, 24 months, 30 months. It's usually in that two-year window, give or take 6 months, is generally about how long it takes for these cases to settle. We've been in this business a long time and have a lot of good data that proves that out. So it's around that time of the 2-year period where a case either settles, the defendant's insurance carrier says, okay, look, we agree to give you X amount of dollars, or the attorneys will take it to trial if they can't settle it, and hopefully they'll get a nice verdict. Hopefully they'll get a nice verdict there. And at that point in time, that's when the money goes from the defendant's insurance carrier to the plaintiff's attorney. They hold it in their trust account. And it's at that point in time, in this example, we have a case on the far right there. The case settles for $100,000. At that point, the attorney gets the money. He satisfies the medical originator, satisfies us for the LOPs that we purchased from the medical providers, and also pays us back the money that we provided to the plaintiffs, plus whatever returns that we are getting on those cases. Typically, we're as the outcome shows here, and on the bottom part of that finish line, we gave the plaintiff $10,000 in pre-settlement funding, and we collected $15,000. So our ROI on that is $5,000. On the medical side, we purchased the LOPs for $10,000, and we collected $15,000. So again, another $5,000 ROI. So all in all, we've invested $20,000, and in 2 years we've gotten back $30,000. So that's the typical life cycle for a personal injury case. And you can move to thank you, Andy. And then again, here we go. This is an overview of how the pre-settlement advances work. Individuals, as we noted, they have a pending lawsuit, they're injured. They typically come to us either directly through one of the attorneys that we have. Most of our relationships are attorney law firm driven. We have relationships with the law firms, and they, given our customer service, which is best in class, the attorneys come to us directly and say, "Hey, I have a client who needs funding," or they have doctors that are treating these clients who need funding, and then they come to us. The next box down, pre-settlement advances, as I stated previously, these plaintiffs generally don't have insurance, or they're underinsured. For instance, a motor vehicle accident, many states have what's called no fault or personal injury protection insurance, and that'll cover them for their initial injuries, but usually it's capped. It's depending on what state, it can be a very low number, and that dries up pretty quickly. Usually in that initial stages of the conservative treatment, chiropractic or physical therapy can chew that up pretty quickly. So they need to come to us because they just don't have the funds to get them through their injuries and treat their injuries. And so they're trading a portion of their future proceeds in the case for money from us now. And then moving down to the next block there, the investment method. We have a team of underwriters, tons of experience in the industry. Many are lawyers, many are paralegals, many have prior law firm experience in the personal injury space. And we collect all this information and documentation from the law firm and use it in conjunction with our data-driven analysis based upon, the years of experience that we have and the data that we have. And generally, we're trying to come up with a value that we think the case is going to settle at. And we are conservative in our estimate. Many of the attorneys may value it. The litigation attorneys are generally, pretty aggressive. But just to be conservative, we'll usually value the case less than what the plaintiff's attorney would value it. And based upon that value, we can fund a plaintiff up to 10 to 15% of the projected value of that case. So going back to the other example, that case settled for $100,000. So given that 10 to 15%, we could fund that plaintiff about $10,000 to $15,000. And that gives us a lot of buffer there between the 100,000 and the 10 to 15 that we funded. So we have pretty good assurances that we're going to recover. Not only the money that we've funded, but the accretion that we've accumulated while that money's been out there. Generally, if you think about personal injury case, think about it. There's a general rule of thumb: a third, a third, a third. That case gets split up. Any settlement gets split up into thirds. A third's going to go to the attorney. A third's going to go to the medical providers that treated that plaintiff, and then the remaining third is going to go to the plaintiff themselves. So it's those 2/3, the medical treatment portion and the plaintiff portion. That's usually the pool that we're being repaid from. And moving to the bottom one, investment structure and flow of funds. Yeah, these are all non-recourse advances. They are not loans. There's a lot of case law and statutes out there that state as much. Non-recourse, what does that mean? That means if the case does go south, the attorney loses, the plaintiff loses, and we don't get our money back. But given our underwriting methodology, given our years of experience, our loss on principal, I want to say what is it, Ryan? It's got to be less than 2% at this point.
It's about 2.3%, stemming back to 2009, and our historical data stems back to 2009. So in this industry, history predicts the future, and the way a case settled in New York and a specific spot in New York, the Bronx, that injury is going to settle pretty much the same way each and every time. And we have enough data stemming back to 2009 to prove out that how we do our underwriting is correct. And, it also proves out that we're right 97.7% of the time.
Thanks, Ryan. Yeah, so it's non-recourse, but we're pretty good at figuring out which cases are good and which aren't. And our contracts, the contract privity lies between us and the plaintiff, but there's an attorney acknowledgement page that's portion of the contract, and that attorney signs off on it as well, because that's the key. The attorney's the one that, when the case settles, that's collecting the money. It's going into their trust account. And we need assurances that when the case does settle, that they're going to give us the funds. And I think that's, yeah, again, we're also dealing with part of this is making sure that the case that's being litigated, the defendant has an insurance company that's A-rated. We're dealing with the Geicos, the Progressives, the State Farms, known entities. So we have assurances that there's money out there to satisfy these cases and settle off with the plaintiff.
One important thing to note is that and to kind of prove out our model is we put out about $127 million, give or take, last year, and we collected close to $160 million last year at a 1.49x cash on cash. So this is proving out our loss on principal for 2023, I think, was approximately 1.7 loss on principal. And so, as we continue to grow and fine tune, our loss rates continue to decline, and we're getting better and better at this as well.
Thanks, Ryan. Yeah, and so here, this slide shows us just some information about our data analytics and our performance. So on the left side, you see the data analytics drive underwriting model, our case value calculator, our advanced algorithm. That goes again to what I was speaking to previously. We have a team of very experienced underwriters. We have a ton of data that goes back, to 2009. We're working with law firms that are proven quantities, that we have a history with. We have an RO, the numbers bear out what their ROI is with each law firm, with each attorney. We have data on that shows how well they perform. And then background checks. We're doing background checks on the plaintiff. We're doing background checks on the doctors that treat them. We're doing background checks on the attorneys that represent them, just to make sure that there's, we're working with attorneys that are properly barred in the applicable state. There isn't any adverse disciplinary history. Similar thing with the doctors. They're properly licensed. They haven't been disciplined by the state medical board. And the plaintiffs themselves, there isn't anything that could be used to impeach them as the case is being litigated, such prior criminal history, or they have some kind of super liens like an IRS tax lien or child support liens that would take priority over us. So not only are we doing a deep dive underwriting the individual cases themselves, but we're underwriting and doing checks on all of the parties involved as well. And the cumulative loss ratio, Ryan was hitting on some of this on the right portion of this slide. You know, we've settled $332 plus million in principal, and we've only incurred losses of 7.5 million, and that's a cumulative loss ratio, as Ryan was saying before, of 2.3%. So we do really, really well, and our MOIC bears out with that as well. We've collected 483 million in cash, which works out to a 1.5x MOIC. And I think with that, we'll turn it over to, I don't know if this is going to Ryan or to Mike. Really?
You can come to me or can come.
Mike,
Go ahead. Go. Yeah. Thank you, Ken. My name is Michael Shaw. I'm the Chief Financial Officer of the company. So I'll be covering the next 2 or 3 slides. I'll start with the company overview. Just again, to repeat, we have 2 main segments, the pre-settlement funding and the medical funding. And we are also have post-settlement funding as well as attorney funding, but that's relatively small compared to our pre-settlement and medical funding business. And we have 13 professionals that comprise of our sales team, and those are the deals that come through the door. In addition, we have an exclusive relationship with brokers and joint ventures where we get the right of first refusal to see all of the deals that come through their door, and then obviously go through our underwriting and through our contracts and our log boxes. And we have more than 2,000 attorneys that we deal with across the United States. We are headquarters in Conshohocken in Philadelphia. And then we have additional offices in New York City, Las Vegas, in Boca Raton. Next slide. If you look at our historical origination, you can see the significant growth that we encountered over the last 3 or 4 years. Looking at 2021, we originated approximately $85 million, going to 127 in 2022. And last year, we closed at $132 million in origination, not including any other acquisition, of course. And then we expect 24 and 25 to be between $170 million to $194 million in origination. And with respect to our EBITDA, we are extremely profitable. From 2021 through 2022, our EBITDA was $43 million and $51 million respectively. And last year, our EBITDA was $53 million, and we're expecting to close this year close to $60 million in EBITDA. Next slide, please. I'll be walking you through the single unit economics. If you're looking at our pre-settlement funding, our average advance is approximately $6,500, and that's based on expected settlement value of $104,000. That's representing a 6.3 of loan to value ratio. If you remember, Ken was talking about the 10 to 15%, so we're extremely conservative in our underwriting, and we can go all the way up to 15%. But our average advance is at 6.3% of the expected settlement value. Cash on cash, for every dollar that is deployed, we're getting 40% back. So cash on cash is 1.4x on our dollars deployed out of the door. Looking at our medical funding, our average advance is a lot less than our pre-settlement funding. It's approximately $2,800, and that's based on expected invoiced amount of $13,000. That's representing a 22% advance rate. Cash on cash historically has been 60%. I'll turn over to Andrew Zach, who's going to cover the recent offerings that the company had. Thank you.
Excellent. Folks, what you see on the screen here are the private credit investments that Experity has offered just since 2021. We've got not only a lot of experience in our business, but a lot of experience in bringing reliable, fixed rate, high yield credit investments to accredited investors so that you can diversify your investment portfolios. Two things of note on this screen. The current offering, which I'll detail next, is providing higher yields than any of these other investment offerings that we've brought to market since 2021. And very importantly to any investor, especially in a private placement, on the bottom here, all invested capital from these first three offerings where you see an asterisk next to them, all invested capital has been fully redeemed to our investors. The only reason the fourth one has not is that Mike brought that one to market in 2022. We closed it in June of 2023. That investment is a 5-year subordinated note that has not matured yet, but our investors continue to enjoy the consistent high fixed rate interest payments each and every quarter. Finally, our current investment offering, for those of you who like what you've heard about today, we're offering a 12% subordinated note investment with distributions paid from the company quarterly. So each investor will receive their payments from us on January 15th, April 15th, July 15th, and October 15th. So for instance, if you wanted to invest $100,000, each quarter you'd get a $3,000 interest payment paid back to your account. If you wish, you can use cash or IRA dollars to invest. So many of you on this call are current CAMA clients. You've already have a self-directed IRA set up, and you can use that to make this investment. For those of you who do not have a CAMA self-directed IRA, it might be time for you to get one. You could take advantage of our private placement with any of your qualified dollars outside of a 401k plan, if you're still working there. So if you've got money in IRAs at Vanguard, Morgan Stanley, or JP Morgan, feel free to reach out to me. My team will expertly guide you through the transfer process to move those proceeds to CAMA so that you have it in the vehicle you need to invest your qualified dollars into a private placement investment. What else here? Minimum investment, $50,000. I should also note that we at Experity believe in transparency for our investors. We've got clean audited financial statements for each year we've been in operation. Those are available for investors' review during your evaluation process. I think speaking for investors in general, they really appreciate the investments we bring to market for a couple of reasons. Number one, when Mike sets an interest rate for a particular offering, that is fixed for the duration of the term. So our current offering of 12%, that will not change. It doesn't matter what the Fed does to adjust interest rates. Once you subscribe to one of our investments, that interest rate is locked in for the duration of your investment. Secondly, our investors in general, I think, appreciate the portfolio diversification that an investment in the ThriveS legal funding will provide to their portfolio. One, you don't need to worry about what impact inflation will have on your investment in the future. Any economic recession will not impact it. Any stock market reductions will not impact this portion of your portfolio. So again, those of you who are interested, feel free to reach out to me, set up a call, email me, call me, and we'll be happy to walk you through what an investment would look like. Will, with that, I'll throw it back to you.
All right, perfect. Thank you so much for the great information and your time for the presentation. Do we have any more questions while we have the individuals with Experity Ventures time? If not, it looks like, did you answer the question about regarding accredited investors?
Happy to do so. So ThriveS is an accredited investor-only investment. So there are some specific definitions that the IRS has for accreditation. You need to have investable assets of $1 million or more. That can be paper assets. It can be real estate equity in any property other than your primary residence. And it also can be the value of a business. There's also an income lever that you can pull. Usually if someone qualifies from an income perspective, they've got the assets. But if you file a joint tax return and your bottom line net income the last 2 years was in excess of 300 grand, the IRS considers you accredited. If you file an individual return, the number you need to exceed the last 2 years is 200,000 in income.
Okay, thank you for that answer. Thanks for the question. Jim in the audience is also asking or saying that he was late. He's wondering what LOP stands for.
LOP is a letter of protection. A letter of protection is a relationship between the plaintiff in the personal injury suit and the doctor, where it says, I will provide you treatment in return for this letter of protection, which is acknowledged by the attorney. So when the case settles, the attorney has to satisfy that letter of protection.
Okay, great. Thank you for that. I'm looking through the questions.
I think there was a question in there regarding investing in a specific asset. You're not investing in one specific asset. You're investing in the pool of all of our assets.
There was also a question here, do you have priority over the lawyer's third cut? We do not. The attorney's fee and their expenses generally come off the top. However, given the relationships we have with them, sometimes, you know, if a case settles for less than they anticipated, they'll frequently work with us and, you know, they'll reduce their fee or the cost so that we can, you know, get back our money and at least some of the accretion.
Thank you for that. Another question just came in. What is the relationship between Experity Ventures and Thrivest?
Experity Ventures is the holding company. So we are the parent company for a portfolio of investments, one of which is Thrivest.
Thank you for that. Jim asks, is my investment with you protected at all?
It is protected by the assets and the equity inside the business. Currently, we sit at about, Mike, correct me if I'm wrong, I think we're sitting somewhere around $75 million in equity.
That's correct.
Awesome. Thank you. Thanks for the question, Jim. Jay asks, which part of the capital stack is the security at?
Mike?
So it's subordinate to our warehouse lines. We have warehouse lines with 2 banks here in the US, and we also have corporate debt, and so that sits below the corporate debt, but between our equity.
All right, thank you for that, Mike. Any more questions coming in? Is there a reinvestment option?
Angie?
In essence, is the question specifically, can you leave your interest in the particular note to compound? If that's the question, our current offering is not set up to offer that. We distribute the interest payments to all investors each quarter.
Thank you for that answer. Thanks for the question, Craig. Ryan asks, this funding round solely for providing more capital out for cases, or will some of it be for growing the company like more employees?
It is primarily to continue supporting our mid double-digit to low triple-digit growth year over year.
All right, thank you for the question. Thank you for the answer. Another question just came in. Who are the lenders, actual names, banks senior to these notes, if you can answer that?
Yes, East West Bank and Synovus Bank. We have 125 million with Synovus and 130, I believe, $32 million with East West Bank.
$135 million with East West Bank, and we're currently in the process of setting up a third warehouse, a revolving warehouse facility.
Perfect. Thank you. Another question: does the investment have to be 5 years? Are there any other options? Anything less?
I should note that the duration of the investment is 5 years. I'm glad that question was posed. There is an early withdrawal privilege that each investor gets with some written caveats that I'll clearly explain and are clearly explained in the PPM. After 1 year in the investment, this is set up as a standard interval fund. Experity will honor withdrawal requests up to 20% of the total amount raised annually, with a cap of 5% each quarter. It should be noted that that doesn't apply to an individual's investment. It just applies to the entire pool of money that's been invested. Put another way, if there were $10 million invested into the ThriveVest note, Mike would be willing to redeem, as per the PPM, up to 500 grand a quarter, and he would not care or give priority where it comes from. So that could be one person $500,000 investment, or three people's smaller investment. It's very rare that we get a liquidation request, but if they're made and they're reasonable, they're on.
Perfect. Thanks for explaining that. That's all of the questions at the moment. I'll give another minute for people who are still thinking. Here comes another question. This is an interesting offering, and I will contemplate. Thank you for your time. That wasn't a question, but thank you for that. Paul asks, when does the offering close?
Usually when Mike decides that he doesn't want any more money raised for the particular period of time. It's currently open, and Mike has not indicated to me a close date as of yet.
Perfect. Thank you for the question, Paul. Thank you for the answer. Another question, what tax form do we receive? Is it a 1099?
Yes.
Yeah, that's correct. You get a 1099 interest from the company who's handling all of the payments.
Okay, thank you.
Yeah.
Would this be specifically qualified funds? Will you accept Roth? Well, if you don't mind, I can answer that. It doesn't really make a difference what qualified account you use. It's the same investments you can make out of your traditional, you can make out of a Roth. If that helps, unless you have anything else you want to add to that.
Yeah, we get a lot of Roth investments.
Perfect. Thank you. Ryan asks, will this recording be sent out to review again later? Absolutely. We'll be sending out a recording to all registrants, usually before the end of the day, but if for some reason it's delayed, it's going to be first thing tomorrow. All right. Is the distribution considered an interest or capital gain?
You should consult with your own tax accountant, but it should be considered as interest.
All right. Thank you for that. All right. Any more questions? All right. I think we got them all. If not, the contact information is up on screen. If anybody's watching this recording after the fact, or anybody thinks of any questions after this webinar ends, please use that contact information. Anybody at Experity Ventures, do you have anything you want to close out on, or any closing statements?
We appreciate your time. Thank you very much. And if you have any questions after this, please feel free to shoot them to Andy, and we'll answer them as quickly as possible.
All right. Thank you, Ryan. Thank you, Andy. Thank you, Mike. And thank you, Ken. Thanks, everybody who watched the presentation live and anybody watching the recording after the fact. And I hope everybody has a great rest of their day.
Thanks, Will.
Thank you.
Thank you all. Bye.